Could scale back the number of rate cuts this year and adjust to the new normal, potentially, of higher for longer. There's been a lot of blame going around for this change in forecasts. On top of the list is the Fed and its dovish pivot in December. But in a new piece on CNBC Pro today, David Zervos says traders are living in rate cut la-la land. They are the ones to blame for the recent market turbulence, and not Jay and the Fed. Here to make his case, David Zervos is chief market strategist at Jefferies, joined by Peter Boockvar, chief investment officer at Bleakley Financial Group and a CNBC contributor, and CNBC senior economics reporter, Steve Liesman. Well, where should we begin? I mean, Peter, set us up for a little bit with what you think is going on in the market here lately.
Well, the markets, to what David basically is pointing out, is we've got so used to every time there would be an issue, the Fed's going to cut. The Fed's going to save us with rate cuts. Everyone in commercial real estate, the Fed's going to save us with rate cuts. So just at and also just the way the Fed works, when they move in a progression of events. When they cut, they slash. When they hike, they go like this. So the Fed had a very difficult time of communicating that if we cut, it's not the beginning of a trip down to zero again. It's just a tweak. And I think they got way too carried away. But the Fed's job is also difficult because I see a remarkably mixed economy and very uneven. And you have commodity prices near the highest level in a couple of years. I think they're trying to even figure out. They're like in this hall of mirrors that they're looking out the next meeting. They may give us their forecast for multiple meetings out, but they have no idea what's happening past the next month or the past CPI print.
But you think basically you don't expect them to sail to the rest. So, all right, so Dave, put your spin on it. What do you think is going on here? And have they gotten it right all along?
Look, they're going to get it wrong in nuances here and there, and everybody's going to get it wrong. I think the real story that happened is Jay pivoted a little dovishly in December. They moved the dots 25 basis points, and the market took that and ran 100 basis points with it. You got to think about it. The dots moved 25, they moved 100 in 2 months.
Now, I have some sympathy for the market, by the way, because the Fed's usually behind. It's kind of like what Peter talked about. We're sort of used to them catching up from behind and then doing so
But remember,
quickly.
there were already 75 in, so they took it to 175, between 150 and 175. So I think it was an aggressive move by the market that was very excited about the Q4 inflation data, which came in much weaker than expected. And I think the Fed was doing a little victory lap. Jay was sort of saying, hey, kind of poking all the people that said he'd never get inflation back to 2 without the unemployment rate, going way up, and he was feeling pretty good, and the market ran with it. I don't give Jay a lot of the sort of heat for guiding the market incorrectly. The market should be a big boy and take the loss when they take the loss. They went too far. They've ratcheted back. A lot of people lost some money figuring that out. And the equity market, I think, actually did really well in this. It's the rate guys that just kind of got spun out of control.
The weird thing about having this conversation is the past 24 hours has now been, we featured a lot of companies talking about slowdowns or like the bad jobs report. It wasn't even that 150,000, but, it's slowing. So at this moment, then does the rate cut discussion come back then legitimately or not?
It could, but to Peter's point, I think it's important to really dissect the two types of rate cut sequences we could get. One is a modest tweak of, hey, inflation's come down a little faster, the unemployment market rate, the labor market looks a little weaker. These are very modest changes. Or something really bad happens and they have to go big, which I think is an important thing. Possibility.
Yeah.
And that's a good thing for the market, in a sense, the risk asset markets, to know that the Fed is kind of back there. They are back there. They've got inflation in a place where they could do that. They couldn't do that in 22, and they really couldn't do that in 23. So that's important. I do think it really doesn't matter. We've said this from the beginning of the year. It really doesn't matter whether they do 1, 2, 3, 4, 5, 6. It's just the fact that they're back there and they've got inflation in a pretty good place means that they could bring the big guns out if they need them. That lets risk assets go a little bit. And that's why I think risk assets haven't paid much attention to whether we're priced in at 7 or we're priced in at 1. The S&P is kind of up 5 to 10% no matter what.
All right. So